Hello, and welcome to Global Research Unlocked, the Interest Rate and FX series. This podcast is based on our weekly client conference call, where our strategists, along with guests from other parts of BofA Global Research, discuss the most topical and pressing questions faced by our market. I'm Ralf Preusser, Head of Global G10 Rates and FX Strategy.
Today is Friday, 17th of July. I'm joined today by Shusuke Yamada, our Head of Japan Rates and FX Strategy, Meghan Swiber from US Rate Strategy, and Sphia Salim, Co-Head of Global Rate Strategy. Thank you all, first of all, for joining, especially to Yamada-san for joining us so late. So in the interest of time, Yamada, let's start with you. Why are we talking about the asset allocation of Japanese pension funds?
Yeah, thanks for the question. Thanks for dialing in, everyone. So this has become a market theme over the last week following comments from Finance Minister Katayama, who said she wants to encourage investment in Japanese financial assets, including by pension funds such as GPIF. And that naturally led the market to speculate whether Japanese public pension funds could shift part of their falling assets back into domestic assets. We're not really predicting that this is going to happen for sure, because there has been no official announcement and we don't have a specific forecast really for if it's going to happen or timing, size, or direction. But, given higher JGB yields, a weaker yen in recent years, and the government's apparent interest in strengthening domestic capital markets, investors have started discussing the possibility much more seriously in recent days.
Thank you. Now, given that we're all talking about it, I assume that is also because they are big. So how big are they? How do they operate? And what is their current asset allocation, please?
Yeah. If we combine GPIF with the three other major public pension funds, total assets are around 410 trillion yen, or roughly 2.6 trillion US dollar. And all of these funds follow the model portfolio practically approved and set by the government. And at the moment, their allocation looks close to their target. So basically 25% in domestic bonds and also 25% in domestic equities, foreign bonds, and foreign equities. So quite evenly split at the moment.
How would they increase their asset allocation to domestic assets? What options do they have?
There are two really options for them to change allocation. One is through a formal revision of the policy portfolio. The current plan runs through 2029, but GPIF's framework allows reviews even during the 5-year period if conditions change sufficiently. The second is through ordinary rebalancing within existing deviation bands, which gives them a fair amount of flexibility even without changing strategic targets. Now, for example, the domestic bond target is right now 25%, but they have a 6% allowance, kind of a band. So they could increase their allocation to 31% in theory. Over the past few years, they have not deviated from 25%. So if they do, that will be a big change. In terms of what domestic assets they could buy, it would be either alternative assets, bonds, or equities. The first is increasing alternative investments. Recent media reports suggest the government may encourage GPIF to move its alternative allocation closer to the existing 5% ceiling. Since the current allocation is still below 2%, there is some room for that to happen. But if this is the main story, the immediate implications for GGBs or FX may be more limited because they already have some in alternative asset, and also alternatives are typically built up gradually over quarters or maybe years. The second possibility, and I think that's what the market is more focused on, is a shift from foreign bonds into domestic bonds. That looks more plausible today than it did a few years ago, given higher yields and weaker yen. And also there has always been a discussion about whether the public pension funds foreign bond allocation should be as high as domestic bonds at 25%, because their liability is practically in the Japanese yen. And this is basically the scenario that really matters for the market.
So let's talk about that a bit more. What are the implications that you see for the yen if such a move were to happen?
It's going to be positive for the yen. It depends on the scale of rebalancing. If we use a hypothetical example of a 5% shift from foreign assets into domestic assets, So basically cutting foreign bond allocation from 25% to 20%, increasing GGB from 25 to 30%. That will be around 21 trillion yen of rebalancing and potential yen buying. And that's larger than recent series of FX intervention by the MOF. That was around 12 trillion yen in April and May altogether, and also larger than retail investors' annual purchases of foreign assets. That's also around 10 to 15 trillion yen. Of course, these flows will be spread over several months at least, but the scale is large enough to have a meaningful impact on the yen market, potentially measured in several yen or more in dollar yen. The largest G10 impact might be on euro if the rebalancing is from foreign bonds to domestic bonds, because around 1/3 of GPIFs are foreign bonds in euro-denominated bonds. Dollar bonds are over 50%, but given dollar is much higher overall FX liquidity, the price impact would be bigger for euro yen than dollar yen.
Thank you. And what about JGBs?
The impact on GGBs would probably be bigger than on dollar yen just because of the size of the market. The one reason why the GGB market has performed relatively well recently is that the investors have started to view potential pension fund demand as a possible backstop. Potential size of rebalancing could be significant relative to the market size. 5% point increase in domestic bond would imply, again, 21 trillion yen of additional demand. And that's larger than 1 month net JGB supply. That's around 5.5 trillion yen, and even exceeds 1 month of gross issuance. That's 11 to 12 trillion yen. And our view is that the strong get support would likely be in the intermediate part of the curve, particularly in the 10-year sector, but also the 20-year sector could also benefit because of the benchmark duration that is around 10 years. So I would say 10 to 20-year sector could be the beneficiary. So if I had to summarize in one sentence, we're not focusing reallocation, we're not predicting it, but if it were to happen, it will be supportive for the yen and even more supportive for the JGBs.
Thank you very much, Yamada-san, and thank you for joining us so late in your day. Sphia, how worried are you about the spillover from what Yamada-san has described to euro rates?
Hello, Ralf. Hi, everyone. That's a very good question indeed, one we've been getting from many investors over the past week or so. What is the impact on foreign bonds, in particular ECBs? One way to think of it, first of all, is to look at that scenario that Yamada-san outlined of a potential 5 percentage point shift out of foreign bonds into JGBs. That would be the equivalent of around $130 billion shift. Now, in terms of ECBs, what we could assume is that this selling happens in line with the current distribution of allocation in foreign bonds across regions. That distribution seems to actually be matching quite well the index weight of the World Government Bond Index X, GPY, and CNY. So using those weights, it would imply around 37 billion euros of selling of European bonds. Now, I would say that's not a very large amount per se, especially if this is spread out over months. Just to give you a sense, it represents around 2.5% of the gross ECB supply we project for this year. Now, net, like supply net of coupon, redemptions, and ECB buying, it would increase to 6% of that. So basically, that would be a 6% increase in the amount of issuance that needs to be actively absorbed by private investors in the space of a year. So that becomes a little bit more meaningful. But again, in the grand scheme of things, I don't think it would have a dramatic impact on euro area duration, especially in a context where actually we're seeing a lot of buying from other LDI accounts, in particular European insurers and pension funds. Data from the ECB actually shows that just in Q1 this year, euro area pension funds bought close to 30 billion of debt securities. So roughly the equivalent of what we're talking about here in terms of sales potentially by the GPIF. And at the same time, in that Q1, we had actually euro area insurers buy close to 50 billion of debt securities again in the quarter. So we are in an environment actually at the moment where long end demand remains strong, especially with yields elevated. We've seen that last week. When rates sold off, we had quite a lot of demand in the back end of the curve, and that helped ECB curves flatten. So not that dramatic overall, I would say, for duration. Maybe where the impact could be a bit more significant, it's relative value across ECB names. So to give you a comparison, if we split again those sales across the different names based on the current allocations that the GPIF is reporting by country, the sales would amount around 9% of net supply, net of coupon redemption and ECB buyings in Austria and Belgium. Then there would be a bit large still at 7% in Spain and Italy, and then in France at 6%. So maybe it creates a bit of relative value across these names. And it could be more impactful, I guess, in names where the context is a bit less favorable. I'm thinking, for example, the case of France, where we are also facing increased now uncertainty on the political, budgetary, and rating side. So then this type of news around potential selling could increase the pressure on the name.
Thanks, Sphia. Now, that's not the only story in Europe. Obviously, we have the ECB 2 next week. What are your expectations?
We do not expect a hike. We think the ECB will stay put. Oil prices have not really surged to the point where there is urgency to act. We expect President Lagarde to maintain a similar communication as in prior meeting, i.e. talking about meeting by meeting approach, very data dependent focus, but at the same time, possibly still hinting to a hawkish bias. This indeed can be the case with Lagarde referring to the fact that in the latest ECB staff projection, the assumptions that were made included more than one hike. And that was also the case, in fact, in the March staff projection, when oil prices were around a similar level as they are now, if not slightly lower. At that point, while projecting inflation would reach just the target at the end of the forecast horizon, they had included around 40 basis points of hikes, which was what the market was pricing in at the time. So in a way, their forecasting exercises have been pointing to the need for more than one hike. And we think that President Lagarde will remind us of that, and this will maintain a bit of pressure in front-end rates. Besides that, we do anticipate the ECB will deliver a hike in September, but ultimately it will have to cut rates quite meaningfully so over 2027 and 2028. This is because at the end of the day, we do look for inflation to be falling more rapidly than the ECB currently projects, with no second round effects materializing and only a modest pickup in growth. Now, the market may not really focus on these cuts yet because we're not certain that we are completely at the end of the hiking cycle. So we are cautious in the near term in terms of duration, in particular at the front end of the curve. But at some point, we will have to acknowledge those needs for cuts and deeper cuts probably than what the market is pricing at the moment for coming years.
Thank you, Sphia. Meghan, over to you. What about the impact on treasuries from what Yamada-san was describing?
Yeah, sure, Ralf. So in general, we think that the impact of the GPIF reallocation is going to be pretty light for the treasury market. That being said, it's a modest headwind overall to foreign demand for treasuries, which has certainly been wavering over the past several years. Specifically, if you look at foreign participation in treasury auctions, it's now less than 15% overall. Japanese pensions have been among the more consistent sources, I would say, of Japanese demand for foreign bonds in recent months. Banks have been net sellers and lifers have been largely flat, given the fact that foreign yields on an FX hedge basis are quite unattractive for them still right now. So as a result, any explicit reallocation towards JGBs could further reduce that rebalancing flow that we're seeing from these pensions into foreign bonds. But when we look at this data in the broader context, right, TIC data suggests that Japanese investors as a whole really have not been major contributors to treasury demand recently. Japanese holdings of treasuries are up only about 25 billion year to date, and they're below 2024 levels. And this is despite roughly 10% growth in the treasury market since the end of 2024. So really, Japan is not a meaningful offset to the amount of net supply that we're seeing in treasuries right now. While this reduction in pension demand would represent a modest headwind for treasuries, again, the broader data really suggests that Japanese investors have become a less important offset to net treasury supply in recent years, as have foreign investors overall.
Thank you, Meghan. Again, this isn't the only story that's driving the dollar rates market at the moment. We've had a big surprise in CPI this week. How have your views evolved through that?
So we're holding our core views here, Ralph. We're still expecting front-end rates to move up and for the curve to flatten. The CPI data, of course, does reduce the likelihood that the July meeting is live. Our U.S. econ team, though, is still holding the view that the Fed is going to hike in September and deliver 75 basis points of total hikes this year. CPI is one data point. And when we look at what Warsh has said, particularly what we've heard him say reiterated at Sintra, what we heard at the June FOMC meeting, the Fed's been missing on its inflation mandate for the past 5 years. This is not just a couple months of data related to oil prices. And he's really doubling down on this commitment to bring inflation to 2%. Our conviction in Fed reaction function really stems from this acknowledgement that Warsh has made of this long-standing inflation myth. We really think that politically, he doesn't want to own this issue. And for him to not own this issue of persistent inflation overshoot, he's got to take action sooner rather than later. We also see that when you look at the June FOMC minutes, more FOMC participants see financial conditions as too easy versus restrictive. While retail sales didn't come in as strongly as our wonderful B of A card data implied, we still do see that consumer spending is quite robust. And more importantly, we're seeing that not just in terms of the reiteration of the K-shaped economy, but rather that spending acceleration is occurring across income cohorts. Our sense also, anecdotally, Ralph, and what we see from positioning data is that things are pretty clean from a duration perspective. This, coupled with our view for a more hawkish Fed response function, support our view for continued holding underweights at the front end and for a flatter yield curve.
Thank you, Meghan. Thank you, Sphia. Thank you, Yamada-san.
Thanks for joining us today. We hope you found this useful and that you'll tune in next week.
Bank of America and B of A Securities are the marketing names for the global banking businesses and global markets businesses, which includes B of A Global Research of Bank of America Corporation. Lending, derivatives, and other commercial banking activities are performed globally by banking affiliates of Bank of America Corporation, including Bank of America N.A., member FDIC. Securities, trading, research, strategic advisory, and other investment banking and markets activities are performed globally by affiliates of Bank of America Corporation, including in the United States B of A Securities, Inc., a registered broker-dealer and member of FINRA and SIPC, and in other jurisdictions by locally registered entities. Copyright 2026 Bank of America Corporation, all rights reserved.